craze about stocks and investments is all over the internet, but let's face it, the thought of investing in stocks can still be a little bit scary. Many people think that you need to have a master's in economics to understand how the stock market works and the risks involved with investing in stocks. The truth is, however, that anybody can learn how to invest in stocks regardless of their education level or background. If you are looking to begin investing or perhaps take your existing investments to the next level, we are here to provide you with everything you need to know about investing in stocks. The stock market. The stock market is where equities in companies are bought and sold to investors. When you purchase stock in a company, you guarantee yourself a certain amount of ownership in that company. The stock market consists of a variety of different markets. There are large public exchanges, as well as smaller private markets. Two of the largest stock exchanges in the USA are the NASDAQ and the New York Stock Exchange. Investments in the stock market can be understood from two different categories. The first is investing in stocks, which is when you purchase equity from a company. The second is investing in bonds, which is when you purchase debt from a company or government. When you purchase a stock, you are purchasing partial ownership of the company. The company's earnings are distributed to stockholders in the form of dividends, and the stock's price fluctuates with the company's performance. Types of investments. Stocks, buying a fraction of a company and owning a piece of that pie that you hope will grow over time. Bonds, getting paid back by the government or a company with regular interest payments for a loan. Real estate, buying property that can have an increase in value over time. Mutual funds, a collection of bonds and stocks that are professionally managed by a fund manager. Gold, a safe haven that is not influenced by the world's economy. Real estate, a large investment that can require a lot of money upfront. Commodities, a group of things like grains, metals, etc., that always have value. How do you invest in stocks? When you invest in stocks, you are purchasing equity from a company. The company's earnings are distributed to stockholders in the form of dividends, and the stock's price fluctuates with the company's performance. Through stocks, you can amazingly diversify your investment portfolio. The stock market is extremely unpredictable. You can have a good year or a bad year. You can have times when the market goes straight up or go deep down or fall anywhere in between. Investing in stocks, however, allows you to spread your investments across many different companies. This helps to mitigate your risk because if one company suffers losses, it likely won't affect all of the other companies that you own stock in. How to buy stocks? Stocks can be bought directly through a brokerage account or through one of the many investment apps on the internet. These platforms provide you with the comfort of storing your purchased stocks on your smartphone or computer. The only differences among that may occur are mostly in available resources and fees. The best idea for beginners is to start with apps that offer zero-commission trades every now and then. Apps such as Webull and Robinhood are great options for the same as they can make buying stocks a lot more easier without letting commissions take away a major part of your returns later on. Stock market capitalization, also known as market cap. Stock market capitalization is the total shares outstanding summed up and multiplied by the share price. For example, a company's market cap would be $20 million if it has 1 million outstanding shares at a value of $20 each. Market cap is more significant than share price as it effectively evaluates a company in comparison with other similarly sized companies in its industry. Companies are generally categorized by the following market cap. Small cap, $300 million to $2 billion. Mid cap, between $2 billion and $10 billion. Large cap, $10 billion or more. Diversification. Don't put all your eggs in one basket. Before you start buying shares in companies, it's important to understand diversification. Diversification is the process of investing in different types of assets in order to reduce risk. In other words, you don't put all of your eggs in one basket. If you invest all of your money in one asset and that asset loses all of its value, you could be in a ton of trouble. The question then arises, how much money should I put in to start investing in stocks? The amount of money required to buy one single stock varies according to the shares. Shares can be purchased anywhere from a few dollars to as much as a few $1,000s. If you wish to have mutual funds but don't want to invest a lot of money, an exchange-traded fund, ETF, is most probably the right option for you. These trade like stocks, which means you can buy them for a share price sometimes, even less than $100. If you have an investment portfolio that includes stocks, bonds, and real estate, and one of those assets loses value, you can fall back on the others to make up for that loss. Diversification is one of the most important aspects of investing. The more ways you have to make money, the better off you are. Do your research before investing. Before you rush out and start investing in stocks, you need to do your research and figure out which ones are the best fit for your investment portfolio. If you want to invest in a company, you can buy shares of their stock through an online brokerage. There are many different factors you should consider when investing in a company. The first is the company's financial health. You can find information on a company's financial health by looking at their balance sheet, income statement, and cash flow statement. You should also consider the company's product or service, competitors, and management team. The last thing you want to do is invest in a company that you don't understand. You also want to understand the market in which the company operates. This will help you determine if the company has a sustainable competitive advantage. You should also get a feel for how the company's stock has performed in the past. This will help you determine how high you should buy the stock. Choose a stockbroker. There exist two kinds of stockbrokers: discount and full service. Full-service brokers customize recommendations and tend to charge high fees and commissions. Most people agree to pay such high fees because of the resources and research that come with these companies. Paying higher fees also increases the chances of you outperforming the market. You might have to devote more time to your investments if you wish to pay low fees. However, most of the research responsibility lies on the investor with a discount broker. This broker just provides the platform needed for customer support and traders. Newer investors, however, usually benefit from full-service brokers, while experienced traders and investors who have an expertise in doing their own research might prefer platforms with no commission fees. A money manager might also be an option. Money managers select and buy the stocks for you, and you pay them a hefty fee, usually a percentage of your total portfolio. This arrangement takes the least amount of time because you can meet with them just once or twice a year if the manager does well. The U.S. Securities and Exchange Commission offers helpful advice on how to check out your investment professional before allowing them to manage your money and funds. You can lose a lot of money quickly with stocks. Be careful. Investing in stocks can be incredibly rewarding, but it can also be extremely risky. The stock market is very much like an auction. Anyone, whether it be individuals, governments, organizations, corporations, etc., can invest and act as a buyer or a seller. The price of a stock can go low in case of sellers outnumbering the buyers. This, on the other hand, won't be the case if buyers are more than sellers, and in that case the price of a stock would go up. It's a misconception that a company's performance influences its stock price. It really is not so. Investors' reactions to the performance of a stock is the ultimate factor that drives the fluctuation of its price. A company can only indirectly drive the prices. People would want to purchase a stock knowing the company's doing well and might not go for the company at all if the stock underperforms. When you invest in stocks, you are taking a significant amount of risk because the company's earnings and ability to remain profitable is based on many factors which are outside of your control. If the company performs poorly, it may be forced to declare bankruptcy, and you could lose your entire investment. When investing in stocks, it's important to keep this risk in mind. It's also important to understand that the stock market is cyclical. There will be good years and bad years. It's important to keep this in mind when you're deciding how much money to put into stocks. You don't want to put everything into one basket because if the market goes down, you could lose everything. The bottom line. Learning about stock investments might take some time, but mark our words, you'll be on your way to accumulating more and more wealth as you get the know-how of it. Our advice is go through as many investment websites as possible and read as much as you can, test different brokers, and get to know about all sorts of stock trading apps. And make sure to diversify your portfolio to put down any risk. Keep your financial goals and risk avoidance in mind, and you'll soon be a shareholder before you know it. When it comes to investing, The sooner you start, the better off you'll be. The stock market presents a great opportunity for anyone looking to make a little extra money or even turn their life savings into a sizable fortune. Knowing how the stock market works and which investments are best for your portfolio is the first step to becoming a successful investor. Don't be afraid of the stock market. Embrace it, and you could end up being very wealthy in the future. Interested in knowing more about stocks? Then go ahead and like, share, and subscribe to our channel and press the bell icon to never miss an update from us.